And journal entries can be of different types. They can be single entries, that means there is one debit and one credit, or it can be a compound entry, that is one debit and two or more credits, or two or more debits and one credit, or two or more credits and two or more debits. Such entries are called compound entries. We will take examples of such compound entries at a later stage. To start with, we will be concentrating only on the single entry, that means one debit and one credit, so that you can become familiar with the concept of debit and credit as to what account to be debited and what account to be credited. And if journal entries are recorded in several pages, then both the amount column of each page should be total and the balance should be entered at the end of the page and carried forward to the next page. So this is possible in case of those entities where there may be a lot of transactions happening in a single day. So there may be a lot of transactions recorded. In order to ensure that all these transactions totals are taken into account, at the end of the page the totals are done and carried forward to the next page. So by the end of the day or end of a particular period, we know as to what is the total amount of transactions which have been put through the journal. And before we go further, we will have to do some exercise so that you will become conversant with the journalization process. So let us start this exercise of trying to put the entries in the form of a journal and then proceed further. Now let us try to do some exercises on journalization. We have understood as to how journalization has to be done, that means how to record transactions in the journal. Let us take examples and then try to understand the process. So as we go along, you will understand as to how to apply the golden rules of accounting for the process of journalization. The first example, as you will see on your screen, is purchase goods for cash for rupees 4,000. So the first step in journalization is always try to understand as to which are the accounts which are affected by these transactions. First identify the accounts. Then the second step is to identify to which class of accounts they belong, whether they are real accounts, whether they are personal accounts, or whether they are nominal accounts. And depending on which category of accounts they belong to, you have to apply the rule applicable to that particular account, and then record the debit first and thereafter record the credit. So let us start with this example of purchased goods for cash. Here what are the accounts which are affected by this transaction? One is the purchase account, second is called the cash account. So what is a purchase account? Purchase account is a nominal account. It is an expenditure of the entity, therefore it is a nominal account. Cash is an asset and therefore it is a real account. So for the purchase of goods, for the purchase account you have to apply the rules applicable to nominal accounts. What is the rule? The rule says debit all expenses and credit all incomes. So since purchase is an expenditure, we have to debit purchase account. So the first step is debiting of purchase account with 400 rupees. So how do you write it? First you have to write the date, that we can ignore for the time being, but in real life you will have to write the date, and in the particular column you write to purchase account and debit is denoted as DR. So under that you write to purchase account DR and rupees 400 you put it under the amount column under debit. And now you have to do the credit. Credit is what? Credit has to be given to the other account, cash account. Because in case of cash, since it is a real account, what is the rule? Golden rule says debit what comes in and credit what goes out. In this case, cash has gone out because you have paid the money for purchase of goods. So cash has gone out, so cash account is credited. So under the particulars column you write cash account credit, and under the amount column under credit you have to write 400. And after that in the particulars column you have to write the narration. So there you have to say what this transaction relates to. So you write purchased goods for cash under brackets. So this complete recording of transaction of one particular transaction. So this is how we have to proceed. Now let us take another example. X commenced business with capital of rupees 10,000. So here first identify which are the accounts to be debited and credited, that means which are the accounts which get affected by this transaction. So who are the people who are affecting here, which are the accounts? First of course is the capital account, because capital has been brought in by the proprietor. And what has he brought in? He has brought in cash of 10,000 rupees. Though the word cash is not there, it is presumed because he is bringing in capital. So that means he has brought cash. So there are two accounts which get affected. One is the capital account, the other is the cash account. So what has happened to cash? Cash has come in. And what is cash? It is a real account. So the rule is debit what comes in. So cash account has to be debited. So under the particulars column you write to cash account debit and put the amount under the debit column 10,000 rupees. And what is the other account which is to be credited? That is the capital account. So what is a capital account? As we know, it is a personal account. So personal account is debit the receiver and credit the giver. So here money has been given by the proprietor, so it has to be credited. So the full entry will be recorded thus: to cash account debit and capital account credit with 10,000 rupees. Under the narration column you have to write the proprietor brought in capital in cash of rupees 10,000. Then we go to the third example. Of the above, rupees 5,000 deposited in a bank. The money which has already been brought in is now deposited partly in a bank. That means they open an account and 5,000 is debited. So what are the two accounts which get affected here? One of course is the cash account, because cash is going out of the business entity, it goes to the bank. And the other account which is affected is the bank account. So because you are opening a bank account. So you have to debit and credit one of these two accounts, that is cash account and bank account. Both are real account because they are the assets of the entity. So in the case of assets, the golden rule is debit what comes in and credit what goes out. So in this case, cash has gone out of the entity. So cash account has to be credited and bank account has to be debited because there is an increase in the debit balance of the bank. Therefore, under the particulars column you write to bank account debit 5,000 rupees and cash account credit 5,000 rupees. Under the narration you say cash deposited in the bank or bank account opened with a deposit of rupees 5,000. So identify what type of transaction it relates to. Now let us go to the fourth example. Furniture worth rupees 2,000 purchased. Again the first step here is to identify the two accounts which are getting affected. One is the furniture account, the other is the cash account. But though cash is not mentioned here, it is presumed that the furniture is bought with cash. That means they have paid cash for purchase of furniture. So since two accounts are affected, you have to identify the first two accounts, that is furniture and cash, and then find out which category of accounts they belong to. Both of them belong to real accounts because they are assets of the entity. So in that case, use the rule for real accounts, that is debit what comes in and credit what goes out. So what has come in? Furniture has come in here. So you debit furniture account with 2,000 rupees and credit cash account. So how do you record this? In the journal, first you have to write to furniture account debit rupees 2,000, cash account credit rupees 2,000. Under narration you have to say furniture bought for rupees 2,000 in cash. That is the narration given. Now we will go to the next example. Sold goods to Y for cash rupees 500. Here first identify the two accounts which are getting affected. One is sales account because the entity has sold certain goods. So sales account is affected. Then cash account is affected because it is sold in cash. The entity has received cash for selling the goods. So both these accounts have to be either debited or credited. Sales account is what? It is a nominal account because it relates to income, and cash account is a real account because it relates to asset. So what is the rule for nominal accounts? Debit all expenses and credit all income. So sales account has to be credited. and cash is a real account. So there the rule is debit what comes in. Cash has come into the entity, so you have to debit cash account. So how do you record this transaction? You have to write to cash account debit 500 rupees and sales account credit 500 rupees, and the narration will be sale of goods on cash. That will be the narration. Sold goods to Y on credit rupees 500. Here it is similar to the earlier transaction, except that here instead of selling it on cash, he has sold it on credit. That means no money has come into the entity. It is a credit. So who are the people? Which are the accounts which are affected? One is of course sales account, because the entity has made sale. Second is Y's account. Y has taken the goods on credit. So Y's account is coming into picture here. So as in the earlier case, since sales is a nominal account, you have to credit sales and Y's account has to be debited. Y is what? It is a personal account. So debit the receiver, credit the giver. So is the person, Y is the person who has received the goods, so you have to debit his account. So how do you put the transaction in the journal? You have to write to Y's account debit 500 rupees and then sales account credit 500 rupees. And the next problem is purchase goods from Z on credit rupees 500. So first identify the two accounts which get affected by this transaction. One is purchase of goods, that is the purchase account is affected. Second is Z. Z's account is affected because Z has supplied goods on credit. So since purchase account is a nominal account, as we have seen in the first example, we have to debit purchases accounts, and Z's account has to be credited because Z is a personal account. There the rule is debit the receiver and credit the giver. Here Z is the giver of goods to the entity. So Z account has to be credited. So how do you record this transaction in the journal? You have to write two purchase accounts debit 500 rupees and Z's account has to be credited with 500 rupees. And next illustration is paid rent rupees 500. So you have to identify the two accounts which have to be debited and credited in this. One is of course the rent account, because that is an expenditure, and since money has been paid, rent has been paid in cash, cash account is also affected. So rent account and cash account are the two accounts which are affected. Rent is what? Rent is an expenditure, so it is a nominal account. So whenever the nominal accounts are there, you have to debit all expenses and credit all incomes. So since rent is an expenditure, you have to debit rent account, and cash is a real account. So credit what goes out, debit what comes in. That is the rule for real account. So cash account has to be credited. So how do you record this transaction in the books? You have to write to rent account debit 500 rupees and cash account credit 500 rupees. Similarly, salary, paid salary of 500. Here also salary is a nominal account because it is an item of expenditure. So you have to debit salary account and credit cash account. So this is recorded as to salary account debit 500 rupees and cash account credit 500 rupees. This is how journalization has to be done. So in order to ensure that you remember the rules meant for each class of accounts, you have to practice with certain examples. Now we will go to the second part of the accounting process, that is called the classification of the transactions. That is, whatever entries you have put through in the journal, that means they are taken to the ledgers. Ledger is nothing but a summary of all the accounts which are created. For example, an entity may have accounts such as cash account, bank account, purchase account, salary account, capital account, or XYZ's account, ABC account, like that. An entity may have several accounts, and we would like to know what is the balance in each of these accounts, which is not possible from the journal, because journal is only a chronological recording of all transactions which have taken place. So in each transaction there are two accounts. So over a period of time, a particular account may have got affected by several transactions. So what is the net result of all these transactions? How much is the cash balance in the accounts? What is the bank balance? These can be done only after we segregate the journal entries in terms of accounts. That means whatever is recorded in the journal is taken respectively to those accounts. For example, In the earlier example, we found out that in several transactions, cash account is affected. So all entries relating to cash are taken to the cash account. All entries relating to purchases are taken to the purchases account. So that means this is a method of classifying the different entries into debit and credit depending on which account has been affected. And ledgers are known as the principal books of the accounts in which account wise balance of each account is determined. That means we can find out as to what is the balance in a particular account. For example, if you want to know what is the balance in furniture account or what is the balance in cash account, all this can be ascertained in the ledgers. So what we do is, after journalizing the entries, recorded entries are classified and grouped into different accounts. Entries made in the principal book account wise. That means we have to make entries account wise. So whenever there is a transaction, two accounts are affected. So when we take it to the ledger, each leg has to be taken to one account. For example, in the first example which we considered under generalization, we said purchase goods for cash. There purchase account and cash account are affected. So one debit is taken to purchases account and credit side is taken to cash account. That means only one leg of a transaction which is recorded in the journal appears in the ledger. And this process of transferring the debit and credit items from journal to classified accounts in the ledger is known as posting, ledger posting. So ledger posting is nothing but classification of the items account wise. That means account wise they are segregated based on the journal entries. Now let us find out as to how a ledger will look like. A ledger has got two sides to reflect both the balances, that is the debit balance as well as the credit balance. So debit is traditionally put on the left side and credit is put on the right side. As we see on your screen, each side has got 4 columns. So on the debit side you have got 4 columns, on the credit side you have got 4 columns. The 4 columns are, one is of course the date, second is the particulars, third is the ledger folio, fourth is the amount. And under date normally we write the date, the year first on top, followed by the month and the date in which the recording of transaction has been done. Under the particulars column we always write as to which is the other account affected by this debit. If you are putting on the debit column, that means we are entering the debit balance of this particular account. Let us say we are taking care of the cash account, so where cash has been debited. So when we are entering this under the debit side, under cash account, we have to say under particular column as to which account has been credited. That means the other leg of the transaction is mentioned for the purpose of cross checking, and where that finds mention in the ledger folio, that account also will have a ledger folio given in the ledger. Each account will have a folio number. For example, cash account can be folio 1, bank account can be folio 2 and so on. So that ledger folio number is given. This is only to facilitate cross checking as to whether the correct amount has been taken to the other side also or not. So when we post entries in the ledger, we have to post only whatever it relates to that particular account. So if it is only debit, it will be recorded only on the debit side. If it is credit, it will be recorded only on the credit side. And for this you have to follow certain rules. These are called the rules regarding posting of entries in the ledger. The process of transferring the debit and credit items from journal to classified accounts in the ledger is known as posting. This is the definition. So what posting means is merely transferring all entries which are appearing in the journal to the respective accounts. For posting of entries in the ledger, the following rules will have to be kept in mind. So what are these rules? 1. Separate account is opened in ledger for each account, and entries from ledger posted to respective account accordingly. That means you have to start opening accounts depending on how many accounts you have. An entity may normally have accounts such as cash account, bank balance account, machinery account, or furniture account, or fixed assets account, or they can have bank OD account. So they can have any number of accounts in addition to capital accounts. All these have to be opened in the ledger a separate folio is taken for each account. That means they are segregated by means of different pages. You will have one account under one page, and depending on the number of transactions you may have different ledgers also. For example, one ledger may contain only 10 accounts, another ledger will contain another 10 accounts. So, we will have separate heads for each of these accounts. It is the practice to use words to and by while posting transactions in the ledger. So, this is the convention. For posting debit entries, to is used, while for posting credit entries, by is used. So, whenever let us say you are posting a purchase debit in the ledger account, that is purchases account, there we have to use to. So, where that the other leg of the transaction lies, that has to be mentioned. For example, if you have purchased goods by cash, while posting it under the purchases account, under the debit side you have to say to cash account and put that. So, what it means is the credit side of the debit pertains to cash account, and in the case of cash account you are posting it on the credit side. So, there the debit pertains to purchase account. So, there you have to write by purchase account and put it on the credit side in the cash account. So, there we know that the debit is in the purchase account. So, this is a convention, to and by. The concerned account debited in the journal should also be debited in the ledger, indicating the respective credit account for reference purpose. So, there in the ledger folio we indicate as to what account has been credited and where is that folio, so that there is easy cross checking of different legs of a particular transaction. So, any mistakes committed can be rectified easily. And after that we go to the stage of balancing, and before that we will have to find out as to how this ledger posting can be done. For that we will take the same example which we did earlier and try to put them in the form of a ledger and see how ledger posting is done based on the journal transactions.